Okay, let's get into it. So thank you all for joining. I usually probably make a bit of a joke about tax being the exciting stuff and sarcasm, but actually this is the most attended webinar we've had for a while. Tax is obviously very topical at the moment, and it's been changing pretty fast over the last 6 months. So I'm really looking forward to this webinar and getting some great information. So a little bit of an agenda here. Okay, so we're going to have an initial kind of UK property market update. We're then going to go into the tax side of stuff. Actually, the 2 and 3 probably the wrong way around. We're going to go into the tax side of stuff. Okay, stamp duty, inheritance tax, things like that. Then we'll jump across onto some mortgage information, some recent changes in the base rate. You know, what's the expectation for mortgages, things like that. We'll have a look at a few properties and our kind of top pick at the moment, which has been extremely popular, and then a chance for some questions at the end. So the host today, so I'm second along there. My name's Sean Bennett, spelt the Welsh way. I've got my colleague John Treacy, who will introduce himself in a second as well. We've then got Stephanie Chan, who's going to be going over the tax stuff, who is also based in Hong Kong with us here. We've worked closely with for a long time now. And then last but not least is Neil Jensen on the right-hand side, who has been in property longer than he'd care to admit, I think. But they'll introduce themselves more in a second. So a quick kind of UK property market update. Again, it depends what, I suppose, which bank you look at, which newspaper you read. But over the last 12 months, property prices have increased anywhere from 3.5% to 5.3%, as you can see, the latest nationwide house update. The average asking property price goes 379,000. The average actual property price is around 300,000, but the average asking price is around 379,000 pounds. And interestingly, again, there was obviously a lot of nervousness around the property market. I think in the middle of last year, not necessarily nervousness, but people waiting to see what happened with the elections and things. So the increase in sales agreed is actually up 5%. Okay, so that's kind of looking back a little bit and where we are currently. Looking forward, we've got a slide here on this is a Savills forecast, okay, which came out at the end of last year after the autumn budget. Okay, and this initially, actually, they said the average increase they thought for property prices was 21% over the next 5 years. After the autumn budget, they actually revised this to be 23.4% on average growth over the next 5 years, which is obviously great for the UK property market. Why is that? Again, things we can talk about a lot. We won't go into too much. Huge supply and demand issues. Nowhere near enough properties being built in the UK. Immigration, young professionals coming to the UK as well, plus supply costs going up. And different factors like that. Now, average rise 23% across the UK. You then have certain hotspots like the Northwest, like the West Midlands, okay, these kind of areas. Interestingly, if you look at London, again, these are forecasts, you have to take them with a pinch of salt. But when you're looking at London property price expectations, price growth actually lower than the rest of the UK. We can probably touch on that a little bit later on, the reasons why that is as well. Okay, so without further ado, I'll pass you across to Steph, who can talk you through the recent tax changes.
Thank you, Sean. So yes, this is what I personally believe to be the most exciting part of the presentation. So just as an introduction to myself, I have specialized in UK tax advice and planning for individuals based overseas for about 12 years now. And we are based in Hong Kong, but we do work across the Asia Pacific region and the Middle East. And obviously, one of the most common questions we do get from clients and prospects would be that if you are planning on moving to the UK, you might look to buy a property in the UK. And even those that are remaining offshore, they are interested in investing in the UK property market. So what we'll do is we'll outline some of the key considerations that you'll need to look into when investing or buying a property in the UK for personal use or as a rental property. Next slide, please. Okay, so this is everyone's favorite question, stamp duty land tax, and it's arguably, I guess, the UK's worst type of taxation, because any other taxes, more or less, we can avoid, or rather than using the word avoid, but we can mitigate some of the UK tax liabilities on them. With stamp duty, there is always going to be stamp duty on a UK property purchase unless you are purchasing a property, maybe less than £40,000, which is very rare these days. But what you're looking at now is with a UK property purchase, and regardless of whether you buy it in your personal name or in a company name, you are looking at various different rates of stamp duty. Now, the first column that we see here, the standard rates of stamp duty, you've seen this around for a few years now. I guess what's changed is actually the additional rates of stamp duty. So as of 30th of October last year, they've actually increased that to an additional 5% into each ban that you have there on top if you own a property in the UK or anywhere else in the world. So that's really important to understand. So if you have a Hong Kong property or you have any other properties outside of the UK, even though you are making your first UK property purchase, you are liable to additional rates of stamp duty. Now, I guess what we will go through is how to get that relief back, or how to get a refund on the additional rates of stamp duty. Generally speaking, the only way in which you can get a refund on the additional rates is if you are replacing a main home. So there are various timelines for that, but it's essentially 36 months before or after you purchase that property. So if you are buying a property in the UK to live in, this is a completely different ball game for you, because the additional rates of stamp duty don't really apply. There may be a cash flow issue where you might have to pay the additional rates first, but then you get a reclaim on the additional rates after you've sold your main home. So generally speaking, that's the only relief that you can get to avoid the additional rates. The other option is obviously if you are looking at selling any home or all the other homes that you do have properties in outside of the UK, and then buying your UK property, then you are obviously guaranteed the standard rates of stamp duty. Now, the non-resident surcharge has been around for quite a while. When I mean a while, maybe for the last 3 or 4 years. This is an additional surcharge for those who are considered non-resident. So if you are buying the property as a non-resident, even if you are buying the property as for you to live in, for it to be your main home, there is an additional 2% on top. Now, there is a way to get the additional surcharge refunded, and that is if you become UK resident shortly after the purchase. Now, it's really important to understand that stamp duty, the residence definition for stamp duty is entirely different to the residence position for tax purposes. So for stamp duty, it is based on whether you spend 183 days in any given year from when you've purchased the property. So if you've not been in the UK for 183-day period before the purchase, you are considered a non-resident for stamp duty purposes. And just really, briefly speaking, stamp residence definition for tax purposes is actually based on the statutory residence test, and so you can be resident from between, I guess, 15 days to more than 182 days. But essentially, for stamp duty, 183 days is the magic number. Now, to get a refund on your non-resident surcharge, you will need to go back to the UK and spend at least 183 days within a 365-day period from the date of purchase. So there is a bit of calculations to do, because if you are planning on moving back to the UK, I'd say if you're not in a rush to purchase the property and you know that you will be UK resident, then you should actually wait until you are UK resident to buy the property, because then you just save on trying to claim the additional stamp duty back. Okay, so next slide, please. This is another question that we get a lot, whether or not to buy properties under your personal name or in a company ownership or in trust. Now, just because it's the legislation is complex on trusts, we won't cover trusts too much today. But essentially, it really depends on your circumstances. Now, buying a property under your personal name, you will be eligible for majority of the people that have UK passports or a European passport. They will be eligible for a personal allowance, a tax-free personal allowance of £12,570 on any rental income you may derive from that property. But if you are a Hong Kong resident, Hong Kong passport holder, a BNO passport holder, you are not eligible for a personal allowance. So unless you're a UK resident. So this is probably where you might be better off actually buying a property in a company name, because you do not have access to these allowances. Now, if the first £12,570 is actually tax-free, then this could be equivalent to maybe buying a property under your name for one or two properties, because maybe you'll get rental income of between, £600 to £1,200 per month. And that will just make it below the personal allowance. Any more properties beyond that, then maybe you should consider a company ownership. But again, it does complicate things if you are UK focused and UK connected. So if you want to move back to the UK, it will depend on what you are moving back to the UK for. So if you're moving back to the UK to retire, for example, and you're not expecting significantly any other income apart from rental income, then it probably would make sense to put the properties under your personal name. Now, the difference is the more properties you have under your personal name in which you're generating a rental income from, you actually only get a basic rate of tax deduction on any mortgage interest you receive or you pay for. So, if you're generating between £50,000 to £100,000 of rental income a year, you're only receiving a deduction of basic rate of tax for the mortgage interest. Now, the company ownership, which is why everyone's attracted to it, is that you do get the full mortgage interest deduction. So it really depends on how much leverage you've got on the properties themselves. There's an additional complication where if you are UK resident, then there's an element of double taxation. So corporation tax may be different because it's lower, it's at 19%, and it may go up to 25% depending on how much rental income you receive. But at the end of the day, the company itself will pay corporation tax at 19%, and then you'd have to withdraw from the company. So you either withdraw from the company in mainly three different ways, and two of these three ways are the most popular because people don't tend to set up pension schemes under a rental company. But the first two ways would either be a dividend or a salary. So depending on your UK residence position, if you are UK resident, there will be further taxation on the dividends you withdraw from it and whatever salary you may pay yourself as well. So this is where we probably would need to look at the numbers, see how many properties you intend to I guess, buy or purchase, how many properties you already own, and also what your intentions are with the UK. Because with property ownership, whether or not it's in personal names or in company ownership, really the differences are the deductions that you get and then the rental income that you receive. So it is a numbers game. You'd have to work out exactly what rental income you do receive against your other incomes that you may get outside of rental. I also did, obviously I've spoken about the residence position, but whether or not you're buying it in your sole name or in joint names, that will also play a part, because a lot of people actually are happy just buying properties in joint names. Some people might want to, just for the inheritance tax position, maybe buy a property with their children. So, this will depend on exactly what you're looking to use the property for. If you're looking to use the property for yourself to live in, then company ownership is usually a no-no because you cannot get what we call capital gains tax exemptions on it. So again, as much as attractive as a company ownership may sound, generally speaking, you should look at easier and more simple means than just going straight to a company structure, because there are a lot of companies out there that would market for you to buy a property within a company structure. That would not usually be the first port of call. For me, I would assess actually what you have in terms of your liabilities and your income, and then work it out from there. Also, just one last point on the income tax and versus corporation tax. HMRC are going to be a bit more stringent on the reporting. So as of 25-26, they are now looking to assess whether rental property owners are going to need to report under Making Tax Digital going forward. So for anyone who earns more than £50,000 of rental income personally, will need to report their income to HMRC on a quarterly basis. So this is a bit more in line with VAT, because VAT is quarterly reporting right now. But Making Tax Digital, you can no longer use the online gateway. It will be a completely different software, and it will be quarterly reporting. From next tax year onwards, so for 26-27, that threshold goes down to people who earn rental income over £30,000 and then £20,000 a year after. So what you'll see is gradually we are going to have to do quarterly reporting on rental income. Which is great news for me because it does mean more work and more business, but it does mean that there's obviously a lot more compliance around it, because you are now looking at making sure that you do comply with MTD, because otherwise they will penalize you and impose penalties where there's late reporting. Okay, next slide, please. Next slide, please. Yeah, thank you. Capital gains tax. So capital gains tax is a tax that you have when you sell UK property. And then if you sell UK property within a company, there is corporation tax on the profits. So essentially, you're looking at two different types of taxes when you sell property, depending on your ownership. But the main one that people look at would be the capital gains tax element of it. So it depends on whether you're resident or non-resident. But either way, there's now a separate reporting requirement. So this is really crucial. It's I think it was from 2017. So if you do sell UK property, regardless of whether you sell as a non-resident or as a resident, you have to report to HMRC through a separate capital gains tax return within 60 days from the date of completion. Now, there'll be a big difference between selling UK property before and after you become UK tax resident. Now, the easy way to calculate this would be that if you're UK resident, you are only going to get exemptions or reliefs on the gain if you have lived in it in any period of time. So you cannot get a full exemption on the entire gain, but you can have an exemption on the time that you've lived in it. So if you've only lived in it for 5 years, you've owned it for 10 years, you cannot claim an exemption for 10 years. You can only claim it for 5 years. Similarly, if you sell as a non-resident, you are liable to UK capital gains tax, but only from 2015. So this is why we have the two graphs, because when you sell as a non-resident, you benefit from that uplift. But the way we see, I guess, the way markets work, you're not going to see the gain being equalized on an annual basis where the gain is equal up until the point of sale. What you are looking at is most likely pre-2015, pre-2008, the property prices would have exponentially risen and then flattened out slightly during Brexit. So what we do as accountants and tax advisors is actually compare the two calculations where, okay, if you're selling as a non-resident, you benefit from the uplift, but are you able to get a greater uplift if you use the market valuation method? So the first graph we see here is if we just did it as a straight line time apportionment. So we only exempt the gain, but the gain is equalized across each year. Now, this is beneficial if the property that you're selling has had significant capital expenditure prior to 2015, because what we do is once we look at the 2015, rebasing, we don't tend to look at the history prior to 2015, okay? The second method is if you obtain a market valuation from a chartered surveyor, okay? So we would recommend you get a red book valuation because it is black and white. So it does mean that HMRC will not they don't tend to inquire into the valuation that you've given them if it has been taken from a chartered surveyor. And usually what chartered surveyors would do is they'd go to the property, inspect the property, and then make a judgment on what they think the market value should have been in 2015. So you can take that backdated valuation and then use it to see whether you can get a greater uplift on the gain. Now, a lot of people assume that once you've got a 2015 valuation, you can carry that home, go back to the UK, and then use the 2015 valuation when you're already UK resident. That is not the case. So as soon as even if you've taken a 2015 valuation, if you trigger residence in the UK and then you sell the property, the full gain is liable to UK capital gains tax, okay? And just at the beginning of this chapter, I did mention, obviously, you would get relief for when you live in the property. Now, if you live in the property, you would get a relief for that time period only. But there are periods in which if you leave the property, maybe go to Hong Kong, Dubai, Singapore, and then come back to the property to live in, that period of absence that you have, it may be exempt from capital gains tax as well, but it'll be dependent on a couple of conditions. So one of the conditions, for example, is you do need to have spent 90 days in that property for it to qualify as a main residence every tax year. So if you haven't let it out, it's available for your use and you are non-resident, in order for that to qualify as your main home, it has to be lived in for at least 90 days a year. Now, for those of you who are a bit more familiar with the tax system, you'll know that the 90-day period usually catches people out for residents, because some people may become resident after spending 90 days in the UK. So again, this you'll have to be very careful about, because by becoming UK resident, you may be subject to UK income tax and capital gains tax on your worldwide estate, worldwide income and gains, or you benefit from capital gains tax exemption. So it depends on what your circumstances are at that time. Next slide, please. So this is a very quick one, but inheritance tax is obviously very topical. It's usually what we deal with first and foremost, because inheritance tax prior to this tax year was based on your domicile position, and now going forward is actually going to be based on how many years you've been resident in the UK. Now, inheritance tax in the UK is based on a flat rate of 40%. Okay. There are a couple of other percentages that we do deal with, but it depends on what, lifetime gifts, trust, various ways in which you can sort of expedite some of that gifting, which will maybe mean that you have to pay different rates of inheritance tax in your lifetime. But generally speaking, inheritance tax is imposed when, touch wood, but when you die. So when you die, and if you are relevant to, if you are considered to be a relevant individual for inheritance tax purposes, say you've been in the UK under the new regime for at least 10 UK tax years, or 10 out of the last 20 UK tax years, then you have to look at your worldwide estate for IHT. And this does not exclude UK property. So for those of you who are remaining outside of the UK, UK property is still within the scope of UK inheritance tax. Now, a lot of companies market the fact that if you put it into a company, it might be better for inheritance tax purposes. I wouldn't say that's the case. So usually it's based on the fact that they're utilizing the gifting rule. So if you have a company structure for your properties and then you gift away 10% every year, you pay capital gains tax on that 10% gain, the gain within that 10% apportionment every year. But then from that point onwards, you'll need to survive 7 years from each date of gift. So it's the same thing as if you owned a property under your own name and you gifted it away, you just need to survive 7 years as well. So I wouldn't say company restructuring or company structuring for a property is, the way forward for inheritance tax planning, because it's pretty much the same thing. It just gives you maybe that additional flexibility, but then there's extra reporting to do. So the cost may outweigh the actual, inheritance tax benefit. But what's also worth mentioning is, again, if you are remaining outside of the UK and you're not going back to the UK, then you're only liable to UK inheritance tax on your UK estate, which means if you have UK properties, we then need to look at what's the value of these properties, what's your allowances that you have. So each person does have what we call a nil rate band, a tax-free inheritance tax allowance of £325,000. If you are, when you pass away, if your estate or the property that you own in the UK used to be your main home and your total estate is less than £2 million and you're gifting that property to descendants, so to children or grandchildren, then you have an additional benefit of £175,000 as well. So this is really worth looking into, because actually each person can get up to £500,000 of tax-free allowances, which, if at that point the only relevant estate that you have is UK property, then you actually have £500,000 of a buffer in terms of the IHT position. Okay, next slide, please. So this is a very interesting recent case. I'm not sure if, that's coming up. So these articles came out within the last week or so. You'll see this article dated 15th of May. It is from the Daily Telegraph. So with this particular case, it's very similar to what I've mentioned before, but it was put into trust. Now, a lot of people assume once you put into trust, you do not need to pay inheritance tax on it. That's wrong. So if you are putting a UK asset into a trust structure, regardless of whether the trust structure is overseas or not, the actual underlying asset within that trust is a UK property. That part of the, if that part of the portfolio of the trust will be subject to the relevant property regime. And the relevant property regime is actually just another word for inheritance tax, but for trusts. but it's a bit different. So with inheritance tax on trusts, it's actually based on whether or not you take out a capital distribution from it, or whether or not there's a 10-yearly charge. So every 10 years from the date that you have a UK property in a trust, there will be what we call an inheritance tax charge on it, but it's called a principal charge. And this principal charge maximum would be at 6%. So you do pay, in theory, a couple of inheritance tax charge on UK assets within a trust structure. And over time, you'll see that actually, I think after 30 years or so, it'll end up being the same amount as if you passed away and then passed it down as well. So you've got to be careful with putting money into a trust structure. With this particular client case, what's happened is Mohammed actually had a property and a shop, and he gifted it into a trust. Okay, and if he survives 7 years from it, then that trust is technically outside of his estate. So you don't need to include the value of that trust within your own estate for inheritance tax purposes. What's happened here is that he'd obviously gifted it away. The beneficiaries were the children. But following the gift to the trust, he actually returned to live in the home to care for his adult daughter. So actually, even though he's gifted it and he has survived 7 years from the date of the gift, it was not an outright gift. Okay, so he did not outrightly gift it to the trust because he then subsequently enjoyed a benefit from it. It was a gift with reservation of benefit. So in this particular case, it obviously went to court. HMRC solicitors said, not only may you have your cake and eat it, but if you eat more than a few de minimis crumbs of what was given, you are deemed for tax purposes to have eaten the lot. So actually what has happened here is not only has the trust continued to have the inheritance tax charges on it at 6%, but the value of the trust has now been included back into his estate for inheritance tax purposes, and there's an additional £176,000 of IHT to pay. So this is where a classic case of not taking maybe some advice at the beginning and then not taking advice going forward. So again, this is where it's really key, especially when you're using a non-UK, sort of, I guess, corporate ownership or trust structures. You understand what the risks are involved and how to mitigate these. So essentially, a very quick overview of how trusts or companies and owning UK properties may affect, the income tax and inheritance tax and the capital gains tax position. But obviously, it really depends on each of your circumstances, where you are resident, whether or not you're planning on moving to the UK to retire or to work in the UK. That will come into play when you buy a property in the UK. So that's all from me, and I think I'll hand you over to Neil, who will talk about the mortgage interest.
Thanks, Steph. Hi, everyone. Thanks for joining. My name's Neil Jensen. Yeah, I've been dealing with mortgages and property longer than Sean's been born. So, yeah, it's quite a long time. And he's not a young lad either, are you, Sean? Okay, next slide, please. So, who we are, we're based in Hong Kong and UK. I'm ex-Lloyds Bank International. I did 23 years with them. That's what brought me to Asia, and I stayed. So, we're Asia and UK. 35 years in property and banking. Um, our sweet spot is non-UK residents, foreign nationals. If we're dealing with people that live in the UK, there's probably a foreign element. They've just arrived there, worked for a foreign company or something like that. We rarely get involved with UK residents. There's no need to do so. So we've got a full end-to-end knowledge. I ran a UK property agency for 7 years, so I've worked on both sides of the piece. We do a lot of new work, build work. It's very different to remortgage or buy in secondhand. And we're very solution focused. Obviously, we want you to get the best deal. We want you to get the cheapest lender. But the main thing is that we get you a lender that is actually going to conclude the deal so that you can get a set of front door keys. It's very important. Next slide, please. The mortgage headlines. Well, something that surprised me a few days ago. We've just seen an expat deal come out in the market from a UK building society. This is for UK passport holders that plan to use a property for their own good or for their family, kids, whatever. in the UK. 90% loan to value, not seen that for many, many years. That evidences that lenders have a huge appetite to lend to people overseas. Sometimes what we see is that if the UK market has been a little bit quieter, that actually offers really good opportunities for people overseas. So don't always wait for the stars to align. Sometimes you find that if there are less mortgages happening in the UK, they will go outside and offer you these deals. Don't assume that these deals will always be there. So opportunity knocks at the moment. The Bank of England has reduced the base rate down to 4.25. They do plan to reduce it again this year. We can get mortgages these days. We, other brokers can as well, but we can um, get mortgages if you have no salary or earned income or you're on a probation period, anything like that. It's not going to be the cheapest rate in the market, but sometimes, for the sake of 1%, but you make 5 or 10% on a property, then it's possibly a good deal to do. So just because you're not earning, if you're buying a property to rent it out, there's still options available. I've put in most lenders offering fixed rates, not always reducing following Bank of England announcements. We A lot of people in the last couple of weeks, and it's happened a few times where they've said, "I'm waiting for the fixed rate to go down because the Bank of England have just dropped the rate." The reality is that a 2 or 5 year fixed rate is based on a projection of the market, not based on what's happened last week or the week before. They've already factored this in. They've got a good idea. They're buying from the markets. A lot of lenders buy their money from swap rates in the market. Therefore, a lot of this is factored in. So if you're sitting there thinking, "Oh, okay, I'm going to wait for the rates to come down further," well, they might do, but the prices might go up in the meantime. So it's often false economy. The fixed rates are often a lot cheaper than the variable rates anyway. And the stat I found, which was very poignant, if you think that base rate is still expensive, in the years between 1975 and 2007, UK base rate was 3.5% at its lowest and 17% at its highest. I remember all of those, sadly. Um, and yeah, it was pretty scary when it was really high. I bought my first flat and signed for a mortgage on the day that the UK announced they were leaving the single currency, and I think the rates went to 13%. So when people talk about 4.25 being quite expensive, I think we need to probably put that into perspective. Next slide, please. Okay, so there's just the graph just shows you where the journey that we've been on. Obviously, it was at 1% and zero point 0.1 for many, many years. And then you saw that stairway to hell between sort of 2022 and 2024. And, there was a worry that where's it going to end? And there was predictions of price crashes and all sorts of doom and gloom. That is no longer the case, and we're starting to see a downward staircase, which is really, really good news. Next slide, please. And again, um, it's common knowledge anywhere you read, even the Bank of England are saying it on their websites that they do expect rates to go down further. Nothing is guaranteed. There's always a chance that something will happen in the market that changes that. So again, we can't always assume, but rates are looking good, and this is why the fixed rates are quite attractive at the moment. Next slide, please. Okay, I've put some rates on here. I don't know how well you can actually see those, but we've got these are borrowed in your own name, and I've got a contrast of 60% loan to value and 75% loan to value. Some lenders price for risk, so the more you borrow, the more that they charge. But the cheapest rate on the left-hand side is the second one down, which is a 2 year fixed, um, which is 4.39%. The cheapest rate for 5 years is actually a 5 year fixed, and sorry, it's 75% is a 5 year fixed, and it is 4.59. Now, Just as one more comparable with this lender, if we look at the 2-year fixed rate for 60% loan to value, if you wanted a variable rate, a tracker, and you wanted to wait for the rates to come down, that rate today would be 5.13. Now, if rates are going to come down, say, 2 more times this year and it drops by 0.25% each time, well, you're still not going to get to that 2-year fixed rate. The other thing that's been quite interesting is that rates have tended to fall every 3 months or so. They've not necessarily fallen in consecutive times. So again, you could be waiting 6, 9 months. You could be waiting a year to actually get parity with that 2-year fixed rate of 4.39. So if your mentality is, oh, I'm going to wait for the rates to come down, well, you might find that that's the best that they get to anyway. A lender is always going to want to try and make money from a mortgage. In the Lloyd's days, base plus one was the rate that most lenders were offering. Certainly Lloyd's were as well. And that tends to be the benchmark for me. So if base rate's 4.25, I would say that 5.25 is actually quite a fair rate at the moment because the bank is making around 1% on that. So just keep that in mind if this is the barrier for you entering the market at the moment. I actually think these are decent deals. Next slide, please. And finally, we're very, very easy in terms of route to market. We've got two very easy fillable PDFs. What you see is what you get there. I'm an advocate of minimal paperwork wherever possible. You can fill these in on a mobile phone or on an iPad, and this just allows us to get a very, very brief snapshot of your situation. The form on the right-hand side is a fact find that we would just evaluate. It's completely private and confidential. The form on the left is a UK property buyers checklist. You can fill that in. You can put the address of your property, and we can look at whether you're underlet, whether your mortgage rate is decent. Maybe you might want to unlock some unused equity from it. It might well be that your mortgage rate is too high and you need to change it. So again, if you get a spare 5 minutes, fill that form in if you've got one or more properties in the UK, and we'll have a look at it and just give you a view as to where you are with it. And that is me. And I'm going to hand over to John now. Thank you.
Thanks, Neil. Yeah, so I'm John Tracy. I work for Centric. I'm also based in Hong Kong with Sean, and we cover lots of Asia. So we spend a lot of time in Singapore and a lot in the Middle East and Dubai with clients. So expats is our focus, and currently these are the properties and the markets that we're currently focused on. Sean. Okay, so there's been some really good, interesting chat in regards to tax and structuring is really important, and we can also help, look at options for you. Product where you're going to invest is really important too. So currently our main hotspots are Manchester, Birmingham, where you can invest in a one bed for 250k in Manchester, just 10% deposit. Sometimes 20%, but 10% on some selected apartments currently, and completes at this time next year. You're looking at sort of 6 to 7% gross rental yields. Birmingham prices from 230,000. Both of these are right in the city centres. We've got something very interesting with a really large developer in Cambridge, prices from 305,000. But I want to come on to our current best pick, which is in Reading currently. So when I first got to Hong Kong, it was kind of London or nothing for the first 5 years. And as Steph had sort of attested to, a lot of people made a lot of growth in London, especially from overseas up to 2015, between 2010 and 2015. So that's really calmed down in London in regards to price growth. But Reading is this perfect storm of being very close to London, so 23 minutes into Paddington. This particular project is a 3 or 4 minute walk to the station, but you've got so many tech jobs in Reading itself. It's sort of deemed as the Silicon Valley of the UK. So you've got Microsoft, Apple, these kind of big Ericsson, these kind of companies have got a big footprint in Reading. But you also got that commuter crowd where you can get 23 minutes into London, get to Heathrow in less than 30 minutes on the train, and you've got the M4 nearby as well, which gets you to Sean's country in Wales quite quickly. So yeah, next slide. Okay, so there's a huge amount of regeneration there in Reading. There's lots of new office jobs and commercial spaces being being risen, but also we look at the rental data. So rentals are up over 12% year on year in Reading. That's way outperforming the rest of the UK in a lot of markets. So Reading's for one bed in Reading, we're looking at sort of rental yields of around 1350 to 1400. On the same asset price in Birmingham, you're looking at about 1100 to 1200. So Reading is really giving that alpha yield. So when interest rates are a little bit higher, they're not too crazy at the moment. They are coming down, as Neil mentioned. What you need to be getting that rental yield. So the rentals are particularly strong. So this particular project completes in November this year. So just 6 months, 6 months away to completion. Price is from £237,000 currently. 20% on exchange, balance on completion, but with rental yields of sort of 6 to 7% gross, netting about 6. It's really a standout crowd, and this has sold extremely well to expats and people in the UK alike. So yeah, one to look into for sure.
Okay,
Next
cool.
slide.
Thank you very much, John. Thanks for talking us through that, and thank you, Stephanie and Neil, as well. So we've had a few questions come in, actually. So the first one I'm going to point towards Steph, and I know the company structure is quite a kind of cool thing to do these days. This is one of the big questions we get asked. So if you're a first-time buyer, is it better, or does it make sense to use a company structure in your opinion, or is it better to buy in a personal name?
Yeah, so I covered this slightly before. So again, it depends on whether or not you get the personal allowance and what is the property used for. If we refer back to some of the examples that John actually just showed a couple of slides back, if we're looking at an average value of a property between £250,000 to £300,000, the rental yield on that, if it was 6 to 7%, is about £15,000 per year. So £15,000 per year, net of expenses, say management fees, etc., you can get that down to the personal allowance, which is 12,570. So there is no need to complicate things to put into a company structure. But again, if you're already having you've got a property portfolio already, and these are additional properties that you're buying, then yes, you can consider consolidating your property portfolio into a company structure and buying it outright through a company. Again, the company structure, what people don't tend to say is that it can be 15% stamp duty flat rate, unless you are letting out a property with a commercial view. So if you're looking to buy a family home, you cannot use a company structure because the stamp duty is way too heavy on that. So that's just some of the things to look into. But yes, maybe one property per person under personal name, and then any additional, you could look into a company structure.
Well, it makes sense. I was just going to say, I had a case recently of a client who bought a property outside of us, and they had actually, obviously, being a first-time buyer, you get certain kind of allowances, I suppose, and you pay less stamp duty for your first property, but they were advised to put their first property under a company structure, and they didn't get that relief. They ended up paying the higher stamp duty as well, right? So
Yeah.
with that in mind, I was going to kind of probably make my own question up. If, say, you have a married couple and one partner has a property worldwide and the other one doesn't, that person without a property, are they then considered, does that have an impact, the fact that their partner has one and they're married?
Yes, unfortunately, married couples and civil partnerships are seen as one unit for stamp duty. So if the wife, for example, owns a property in Hong Kong, and then they don't own anything else, but the husband is buying the property in the UK, then he'll be eligible for the additional rates of stamp duty. So from that point, I think stamp duty is something that you need to cough up, but over the long term, you're utilizing the fact that maybe you have tax-free allowances, the yield will be higher, and so you're just working on the numbers. Stamp duty is not something that we could really try and mitigate unless it was obviously replacement of a main home relief, or just getting the non-resident surcharge back. They're the only two reliefs available at the moment.
Yeah. Well, thank you. And I guess to follow on from that onto you, Neil, so the company structure, does that have any sort of impact on the mortgage rates or getting a mortgage, especially again if it's a first-time buyer, non-first-time buyer?
Okay, a couple of things there. Great question. So it is often more expensive on the mortgage rate, but obviously there's tax reasons, as Steph's talked about. So you've got to look at it in the full picture. What is always a problem for a mortgage broker is when somebody's already been sold the dream that buying in a company structure is the best thing to do, but they haven't actually looked at the mortgage side of it whatsoever. There are a lot of lenders that won't lend to a first-time buyer through a company structure. Why? Because it's actually quite a complex procedure. So you have to get independent legal advice, you have to get legal fees. There are more costs involved in getting the mortgage because you're not actually borrowing the money, the company is. You're then giving a personal guarantee to that company, and therefore you and the company are separate entities when you're dealing with legals. And there are a lot of clients that go, "Whoa, hold on a minute, I didn't expect all of this." Therefore, it's important that somebody is experienced as a property buyer and knows the transaction that they're getting themselves into. So, yeah, there are a number of lenders that just say, look, if this is your second property, even if you bought the first one in personal name, okay, if you've got a track record, then we'll lend to you. But first time buyers in a company structure, you're really narrowing the options that are available. There are options, but there are less.
Understood. And so, would if we say you're a second-time buyer, and if I was to compare the rate of buying in a personal name and a rate of buying under a company structure, are they usually the same? Is there a bit of discrepancy? What do you see?
They're more expensive, Sean. Somewhere between
Yeah,
1% to 2% higher in
yeah,
most cases. There's greater look. There's greater risk for a lender. Why? Because you could essentially walk away, right? You live 6,000 miles away if you're overseas. Yes, you give a personal guarantee, but how easy is that for a lender to impose? How costly is that going to be for them? Therefore, they price the mortgages for risk on that basis. It's a more complex transaction.
understood. John, moving on to you. So obviously there's been some stamp duty changes recently, right? The relief from 250 down to 125, the lowest bracket, and as well as Steph mentioned earlier about the additional stamp duty. In your opinion, what do you think, if any, maybe not at all, but do you think this is going to have an impact on UK property at all, positive, negative? What's your opinion?
I think if people read their, headlines and, they are not quite as interested as they were, but if people look at the bigger picture, looking like this is for part of your retirement part, 5, 10, 15, 20 years time of investment for most people, then you look at that Savills 5-year forecast, you're looking at 23, 24% growth. So it's a very strong case for investment still. If, over the last 50 years, 60 years, UK market's doubled every 7 or 8 years on average. So, it's still a great asset class. And the other thing is obviously stamp duty. We've got very good relationships with a lot of developers who are offering stamp duty incentives right now. So it is a buyer's market. So, for example, Reading, actually all 3 projects we've got right now, there's a rebate of some description on the stamp duty. So a lot of the time there's a commercial decision made by developers to help buyers. So yeah, I think it's a case of summarising your tax position. Is definitely need to take tax advice if you're looking to build a portfolio for sure, and get in touch with Steph. Mortgages, make sure you can get the best rate for you and structure it the right way. But on the purchasing side, there are advantages to buying from overseas right now. There are some good deals in the market, and there's also some good rebates in the market. So yeah, we've got access to those with our strong relationships with developers. For me, rentals are a really key indicator right now, and something like Reading just ticks those boxes where you're going to get an over average rental and also the capital growth. So just be discerning where you invest.
I think also just to add to that, I had a discussion, a live example of a client at the moment who's looking at someone in London with £715,000. The way that the kind of tax brackets work, you end up spending the tax you pay on, say, a £7,000 place is a lot more than somewhere if you bought 2 places for £350,000. Just with the way that the kind of the stamp duty brackets work. So I think it's going to kind of push these people probably away from the more expensive stuff, i.e. London, I suppose, and push people, these new stamp duties towards the lower price stuff. You touched on it there, John. Last question, and then we'll call it a night or day, wherever morning, wherever you are. You touched on the rental yields there.
Yeah.
How important is rental yield at the moment, especially with the interest rates, I suppose, higher than they were during COVID? How important are rental yields? Is that the only thing we should be looking at? What's your opinion there?
Look, I think it's a bit of a balancing approach. We've always sort of been when we've been focusing on the regional cities, it's basically you're looking for capital growth and rental yield. So you want the rental income to service the debt if you're taking a sensible mortgage of 60 to 70% loan to value, and all of our opportunities will do. And that's really important. Where expats, you've got busy jobs, you don't want to be looking at your bank account having to top it up every month. So that's really important. So rental yield is super important, but at the same time, you don't want to get something that's just going to give you a rental yield and not give you capital growth. So it's a balancing act. All of the projects that we look into are piggybacking off infrastructure, things like that. So you're going to get the strong rental yields, but also capital growth. So I think it's finding that balance between the two.
Cool. Happy days. I think that's it. That's all we've got time for. As John mentioned there, especially the tax side is pretty complicated, and Steph's really good at kind of helping out and supporting the best way forward there. So if you have any questions on the tax, any questions on mortgages or on the UK property stuff, what the market's looking like and things like that, please reach out. But thank you all for joining.
Thanks a lot.
Thank you.